Monday, June 3rd, 2024, Monaco 64, home of alternative economics and contrarian views. Today we're going to look at the banking sector and specifically in the US, but it will affect the whole Western financial system and the world's financial system for that matter. But the banking sector in the US is not as healthy as it seems, and the regulator knows it, but the regulator is allowing banks to hide trillions of troubled assets. And right now, everything seems to be fine because treasury yields are under control. We're going to look at something called duration risk. It sounds complicated, but it isn't. And this is coming from one of the best banking sector analysts on Wall Street who's been around for decades. It's not me. And I think it's important that we look at it. And before we go further, just wanted to ask you if you enjoy my videos to make sure you subscribe to the channel. Make sure you hit the little notification bell to be notified of all my new videos. Yeah, and hit the like button as well if you do enjoy my videos. That's always good for the algorithm. And talking about financial and banking risk, we saw, of course, last year in March that quite a few banks went under. The U.S. Treasury had to bail out depositors that had over $250,000 of the FDIC insured amount. We've seen recently that the FDIC has published first quarter data. It doesn't look good, but it hasn't looked good since late 2022. And what's holding things together right now is the bond market. So why the bond market? Well, because we need to go back to 2008 and QE. What QE has done up until recently is convince banks, investors, and others that interest rates and bond yields were going to remain low forever, like around 0 to 2%. But that has been turned on its head because, why? Well, because eventually people wake up to the fact that we've had massive inflation. And by inflation, I don't mean the CPI. I mean the creation of currency and credit out of thin air, which the Federal Reserve has been doing since 2008. And unfortunately for them and for the banks, they went a step too far in 2020. And a lot of that QE largesse went straight to the public, and that triggered a rise in consumer prices, a rise in commodities, a rise in the cost of living. Yes, they've been able to kind of stabilize that for now, but I think it's going to pick up again. So I personally think the risk for the banking industry is very large. And that's why I've been personally keeping and trying to keep a lot of my savings outside the system. Anyway, let's quickly look at this report here. And I don't subscribe to the institutional risk analyst, and the analyst is R. Christopher Whalen. He's got decades of experience on Wall Street, and he released the latest bank quarterly report. It's a premium service. It says here, Whalen Global Advisors has published the latest edition of the IRA Bank Book for Q2 2024. The quarterly outlook for the U.S. banking industry is available to subscribers to the premium service and features more than 30 pages of charts, commentary about the financial conditions of the sector. Yes, he does a summary, makes a summary of what he's reported. And why don't I subscribe to it? Well, because I'm not really, I don't really need to know all those ins and outs. This is more for institutional investors. But what he said here towards the end of his summary is really, really eye-opening. So here we go. It says the report also highlights the huge amount of duration risk that remains hidden on the books of U.S. banks because of the industry trend since 2008 to retain securities in held to maturity instead of available for sale. Before we go further, I just have a look at what duration risk is a technical term, of course, in the bond market. All it is, as it says here, it refers to a bond or bond portfolio's sensitivity to interest rate changes, accounting for characteristics such as yield, coupon rate, and maturity. So the longer dated the bonds are or the portfolio is, the more duration risk it has because, yes, when interest rates or yields change, it affects the price of long-term bonds a lot more because long-term bonds are riskier. And the way you have to look at it is very simple. If you lent someone $100 for a day, that $100 would be relatively safe. But if you lent $100 to someone for 2 years, there's more risk because a lot could happen in 2 years. So that's what duration risk is. He continues, today most bank securities are booked unhedged in held to maturity, aka hide the duration, hide the risk. Federal bank regulators should require that banks keep most treasury and mortgage securities in available for sale as a matter of financial discipline. The unrealized losses on COVID era securities remain a huge problem for banks large and small, especially, and here we go, if long-term interest rates rise back to Q3 2023 levels or above. We're going to look at the 10-year yield in a second. I'll show you what he means by that. If interest rates rise, then bank solvency again becomes an issue and may cause increased market volatility. The chart below illustrates how the banking industry has attempted to hide trillions of dollars in the COVID interest rate problem by classifying securities as held to maturity. There you go. There's the chart. A massive amount of red ink, as you can see, but it's all been hidden. and the held to maturity is the lighter blue part. And what's that akin to? Well, it's akin to just hiding things under the sofa, under the furniture. One day, someone's going to smell something and say, "What's that?" And they're going to pull the furniture out, and that's what happens when interest rates go up. You can smell the. I don't want to say the word, starts with an S, right? So let's have a look at the what he was talking about there. If bond yields and interest rates start rising to the levels of Q3 2023. Oh, there you go. The 10-year yield above 5%. It's going to create a lot of problems. And back in 2023, when the banks were in trouble as well, we had seen the bond yield, as you can see here, from 2022 rise from below 3% all the way to 4.3% by the end of 2022. And by March 2023, we'd gone back above 4%. And all those banks started failing, right? Silicon Valley Bank and others. So that's what he means by the duration risk. And you also have to look at mortgage rates because if mortgage rates keep going up as well, it affects mortgage-backed securities. So most people seem to think that higher interest rates are good for banks because they can lend out at a higher rate and get more income. But the problem has been that, as I said earlier, most people and people working in the banking sector, investors, they thought that bond yields and interest rates would remain very low for a very long time. They thought the regime of almost zero interest rates that started, even a little bit before the 2008 crisis under Bernanke was going to continue. They didn't realize we're going to see rates go up to 5%. And therein lies the problem. And the more rates stay here for longer, the bigger the problem. And that's why Wall Street has been clamoring, and investors, they've been clamoring for the Fed to cut rates, but I don't think they'll be able to. And what that does to all these securities that the banks are holding as assets, it lowers the value of those securities, because when yields go up, the price of bonds goes down, and vice versa. And the massive move we've had, as you can see here from this chart, since COVID, from almost zero. I mean, Treasury yields got down to 0.3 to where we're now is something that if you ask someone back then in 2020 or even 2021, 22, and you told them, do you think the 10-year yield will go back up to above 5% in the next year or two? They think you're crazy. And I think the trend is still higher for yields. So that's why you need to be aware of this, especially if you've got a lot in the bank, in my opinion, be it as an individual or a business. How do you protect yourself from this? Well, I've always told people here that the best way is to be outside of this system as much as possible. Of course, you're going to have to maintain bank balances to operate businesses and to operate your household. And but I think having a little bit of insurance outside the system is very prudent. By insurance, of course, I mean physical gold and silver or any other asset that's not considered a financial asset, and you have to decide that for yourself. Anyway, that's how things are, and that's why we need to keep, and I always look at bond yields when I do my videos at the end of in the market report, because it's very important. Right now, it looks like they're being kept under control. So the other thing I would say, if you're interested in trying to keep a little bit outside the system, have a look at the description of my video. I have a couple of precious metals dealer affiliates, one in the USA and one in the UK, because these problems are not just US problems, they're worldwide problems, I would say, for the banks. So with that, let's quickly look at where the markets are this morning. It's just gone past 8 a.m. London time. We've got spot gold at $2,325. It's down about $2. The high's been 2,333. The low's been 23.14. So gold's still a little bit under pressure, but still, I mean, way above where we closed the year last year. It was at, I think, 2020 or 2060. Silver has been a little more interesting overnight, over the weekend, because we got back below 30. I woke up this morning, silver was trading with a 29 handle, but as I've been talking to you about the banking sector, silver's recovered a bit. We're now at 30.20, down 19 cents. So the low was 29.76. The high's been 30.65. So the market is still very volatile. What do I think is happening? Well, I think it's a retest of the breakout at 30. And of course, when we broke out of the 26 level a couple of months ago or so, which was a very important level as well. We went almost straight to 30, then we came back, retested 26, and then we tried again to retest 30, and we did, and we broke out. We went up to 32.50. And I think, yeah, this is just a retest of that 30 level, which for now looks like it's become support, but one never knows in the short term. The stock market, the Dow futures is up 86. The NASDAQ 100 futures up 69. S&P futures up 13. To the currencies, they look pretty steady, actually. Not much to report here. Commodities, WTI crude is unchanged, trading just below 77. Brent is trading just above 81. High-grade copper is up 0.4 at 462. And let's just quickly look at the bond market then. The treasuries, which I said are very important to keep an eye on, of course. 10-year yield had been going up towards like 4 3/4. It has come back down a little bit right now, but we're going to keep an eye on it because it's key to the whole, well, to the health of the whole financial banking monetary system. So with that, I'm going to wish you all a very good day and a very good start to the week. Take care. Bye.